Good afternoon. Welcome to Under One Roof MTL, where we are demystifying home ownership one episode at a time. Top of the morning to you, top of the afternoon to you. Happy Parade Day, Montreal. Little drizzly out there, but the rain is supposed to let up. So hope you have a great time if you're making your way downtown to the parade, and hope we can keep you company. Joined as always by the dynamic duo, Fred and Martin. Fred Pichette of Fred and Martin Mortgages. Hi, Fred. How are you?
Good afternoon, Robin. I'm doing good, and you?
And Pretty good. Martin Spalding of Fred and Martin Mortgages. Hey, Martin, how are you?
Breaking news. I barbecued last night. I
It was
barbecued last
barbecue
night.
weather.
It was barbecue weather. The worst is behind us.
I did see some snowflakes in the forecast.
No. Bite your tongue, okay? It's St. Patrick's Day. St. Patrick's Day announces the arrival of spring. Spring leads to summer, the best season of the year.
Okay. You heard it here first.
And I'm barbecuing again tonight. I'm obsessed.
Good for you.
There you
Good
go.
for you. Yeah. Everything tastes better on the grill.
Absolutely.
Let's start with our trivia question of the week, brought to you by Felix and Norton Cookies. You can visit their store at the Blue Haven Shopping Center. It's at 3705 St. John's Boulevard in Dollar Des Ormeaux. If you're the first person to text in the correct response to 514-790-0800, you'll receive delicious cookies from Felix and Norton delivered straight to your door. Our question this week: what percentage of the value of a property should you set aside for closing costs? Something we have discussed on this show at length. So if you've been paying attention, you should know the answer. 514-790-0800. And please make sure to include your name. Guys, it's been a very, very busy week. Let's start with the Bank of Canada's interest rate announcement. They cut rates again. Fred, maybe let's start with you. What impact do you foresee this having on home buyers?
Well, actually, Robin, it's excellent news right now because the Bank of Canada is there to support the economy. By cutting the interest rate by another 25 basis points, actually, the Bank of Canada is doing its job. Obviously, if you're a first-time home buyers, it's good news. The variable rate and line of credit are impacted by that rate cut. On the other hand, it has nothing to do with fixed rate. When the Bank of Canada announced a rate cut, it's directly linked to the variable rate, the prime rate of Canada, which is now the more major banks should follow by reducing the prime rate from 5.20 to 4.95. And obviously, it's a little help for first-time home buyers, especially now that we could also extend the amortization on 30 years instead of 25. That's actually good news.
Awesome. Martin, I'm sure you were happy in the group chat. I think your exact words were, finally.
Well, you know what? I'm really pleased that the Bank of Canada is lowering rates. But what I'm concerned about is, does the Bank of Canada know something that we don't know? And are they preparing for this uncertainty that we're living through, whether it be the tariffs or just the uncertainty of tariffs? Is this sort of like an effort to try to offset what's coming down the pipe? Like, are we going to be facing with
Martin, are you talking
job
about
loss?
recession?
Well, I didn't want to say it, but is it job loss? Is it lower consumer spending? Is it the possibility of a recession? It's great news if you're in the market for a mortgage. Hands down, whether it's a variable rate mortgage or even a fixed rate mortgage, because as we've seen, even fixed rates are coming down because the bond market has taken a hit since January. And there's always a lag time between the bond market and when banks actually start lowering their fixed rates. So if you listen to what the experts are saying, we could actually be seeing fixed rates in the next couple of months in the threes, which is something that we haven't seen. Well, obviously we saw that during COVID, but that was an exception. But prior to COVID, we haven't seen threes in a while. So, it's all good for people who are in the market to purchase a house, to refinance, to look for a better rate. But my concern is it's overshadowing something else that's going that's going on with the economy, and are we heading into headwinds?
Martin, we've been talking a lot on this show about the fact that over a million Canadians have their mortgage coming up for renewal in 2025. If the fixed rate is falling into the threes, I believe CIBC was offering 3.99 fixed for 5 years this week. We are starting to see those numbers in the threes. The people who signed in those, high twos during COVID, they're going to face a little bit less sticker shock. So this may not have as bad of an impact as we've saw, last year, for example. People who had to renew last year, it was a little tough for them.
Well, it's funny you say that, because actually people who renewed last year are calling us up to see if they can actually break their mortgage currently
Oh,
to
wow.
take advantage of better interest rates. CIBC, you got to read the fine print though. CIBC came out
Mm-hmm.
with a 399, but there are all kinds of conditions attached to that. So it's just not
Of
for
course.
everybody. But 399 is a good indicator, because what happens is if any of the big five or the big sixes, depending on how you look at it, start to lower their rates, everyone's going to follow suit. So there were three banks that made big announcements this week. I think it was TD, BMO, and CIBC. And the one that was most aggressive was CIBC. But is that for business reasons, because they want to shore up their mortgage business? Or is it because they see something coming down the pipe that where by offering 399 they're still going to be able to generate some revenue on that? Because at the end of the day, a bank is there to make money, and they're not going to offer something like that unless they know they can still make money on a rate that low.
Fred, are you seeing interest rates across the board coming down? People who are buying cars want to do a home equity line of credit, want to refinance. Are all interest rates impacted right now by these cuts?
Yeah, absolutely, Robin. As we all know, the Bank of Canada reduced the overnight rate this week. But as Martin says, the forecast for the bond yield, which is affect directly fixed rate, is that it's going to go even lower in June, in September, and possibly reaching 1.7% in December.
Mm.
What's that mean? That mean fixed rate are will probably drop a lot this year, but it's really going to start. We're really going to start to see it in June. However, people still have a lot of needs out there. We get calls every week like, can we refine? We need to pay debts, which is there's yeah, interest rate will really help Canadian if it goes down, but in the same time, as Martin says, with the tariff that's probably there, or it's there because from one week to another they remove it and they put it back. But yes, we will need to interest rate will really help if it goes down to lower debts of Canadian. Like.
So,
For
Robin,
sure.
to summarize this conversation, I mean, the key takeaways in all this is whether you have a mortgage or you're looking for a mortgage, it's a good time to be shopping for mortgages. But there's a certain amount of unpredictability that's still in the air. Should inflation come back, obviously the Bank of Canada is going to mitigate inflation by raising interest rates. They lower interest rates to stimulate the economy, but if for some reason there's a backlash and inflation starts to rise, you may see rates go back up. So if you're looking to renew or to buy, locking in right now is not a bad choice. I mean, we've been talking over the last probably 3-4 months now that we're really gung-ho on variable rates because we think the Bank of Canada will continue to lower interest rates. However, you get to a point where it's what you're comfortable with. So if you're comfortable knowing exactly how much you're going to pay on a monthly basis, anything in the low fours is a decent mortgage rate and it'll buy you peace of mind. If you're willing to hedge where the Bank of Canada is going with their interest rates, then go variable. And once it bottoms out, like we've mentioned a few times, then lock in. And you can lock in for 3, you can lock in for 5, whatever you choose to do. But there's a lot of unpredictability. So if you want a sure shot, lock in and buy yourself peace of mind.
Yep. If you want to find out what your lending options are, should you go variable or fixed, get in touch with Fred and Martin. They can help you decide what's the best move right now. Fredandmartin.com is the place to go for all of the information.
This is the Mortgage Minute.
When should you consider refinancing? This is your Mortgage Minute. You should consider refinancing to access your home's equity when you need funds for major expenses like home renovations, debt consolidation, investments, or any big life events. It makes sense if interest rates are low, your home's value has increased, and you can afford the new payment. It's also a smart move if you want to consolidate high interest debts like credit cards and personal loans into a lower rate mortgage. However, watch out for penalties if breaking your current mortgage early. Always weigh the costs versus benefits and talk to a mortgage broker to see if refinancing fits your financial goals.
You're listening to Under One Roof MTL on CJD 800. That's Martin Spalding. That's Fred Pichette. And I am Robin Flynn. We are with you until 1 p.m. Refinancing to pay down bad debt. Martin just outlined it for you in the Mortgage Minute. But I'd love to go a little bit deeper, Fred and Martin, to chat about when refinancing does make sense versus when it doesn't. Now, you mentioned paying attention to the penalties associated with breaking your mortgage early, Martin. Now, what do those penalties typically look like?
Well, it depends. It depends if you've got a fixed rate mortgage or if you've got a variable rate mortgage. So, if you've got a fixed rate mortgage, it's the interest rate differential. And a lot of lenders calculate it differently. So, you've got the big banks who are known for their worst penalties, and you've got the monoline lenders who are a little bit more reasonable when it comes to their penalties. When it comes to a variable rate mortgage, it's generally 3 months of interest when you break your mortgage.
Well, I love to
Okay.
say Martin is also, it's the fixed rate from big banks is the biggest complaint. When the penalty from big banks is the biggest complaint in the mortgage industry across the country. When you had to pay your penalty once in your life, you usually remember. Like I love to say to our clients all the time that a mortgage is not just about a rate. It's about a good lender, good loan condition, and a competitive rate. Most of people make the mistake. They don't read the fine print, and at the end they got hit by high penalty if they end up breaking their mortgage with a big bank on a fixed rate. Which is just
I
be
have a,
careful.
I have a question, actually. It might be a silly question, but hey, maybe you can answer it. The penalty that you need to pay, let's say it's 3 months worth of interest, can that be deducted from the money that you'll be receiving when you refinance, or do you have to pay that up front before you refinance?
No, actually, Robin, it's a good question. Yes, you're not going to have to pay that up front. It's going to be removed at the notary. Let's say you
Okay.
got a refinancing, you refinance your property for $400,000 and you're paying 25 to 50,000 of bad debts. Obviously, the penalty will be included in the payout, which is you won't have to come up with the money. But the maximum refinancing authorized in Canada, it's 80% of the value of your property, the appraised value of your property. Like technically, if it goes over that, it's not going to be permitted.
But often,
Okay.
what Fred will mention is that when you do refinance, you need to re-qualify. So make sure that before you go down that road, that you've got stable income, that
Decent credit.
decent credit, and that you've addressed the reason you got yourself into this situation. So, we've said this to numerous clients that have come to us and say, listen, I got 5 or 10 credit cards. They're all maxed out. I got a line of credit. I've got school this. I've got this. I've got that. I got this. I said, we can do this once. But once it's done once, the equity that you want to tap into, if ever you need to do it again, is probably maxed out. So what you need to also address is the behavior that got you into this situation. So if you can't live within your means, you can only go to your home's bank, which is the equity found in your home, a certain amount of number of times, and you're just going to run out of equity. So what you need to do is you need to curb your spending if that's the reason why you're refinancing your home to pay down high interest debt. If you've done this once, make sure you don't do it again, because there just won't be enough equity for us to be able to do this for you again.
And when you do this, let's say you consolidate a bunch of high interest debt into your mortgage, we're looking at credit cards. Do people typically consolidate things like auto loans into this as well and pay off their cars, or is that something you would suggest not doing?
Yeah, it happens sometimes, Robin, that we have to pay out the cars to make sure that the file qualify based on ratio. And I'm sure we talk a lot about it, the GDS, TDS. You need to
Yep.
qualify based on the 5 years fixed interest rate plus 2%. And sometimes because the car, it's a monthly installment, and some people has a car payment up to 800, 1,000 a month, that make the file not qualify. Like sometimes, if someone has a, instead of a lease, he made a purchase, we could pay out that car, um, and then proceed with the refinance. I would say it doesn't happen all the time. We usually try to leave the car because some of the car has a low interest rate or
Yeah.
loan. But again, it could happen that, and sometimes it's better for certain people just to pay to clear everything. It's a little step behind to make two step further.
One
Yeah.
thing that we do a lot these days, unfortunately, is divorces. So you've got a couple
Mm.
that purchased a house, they're both on title, they're both on the mortgage, and they decide to separate. One wants to stay in the house and wants to buy out the other. So we refinance and we remove the other from title at notary. And by refinancing, one pays out the other.
Yeah, I think we do this transaction once every 2 weeks, 3 weeks, sadly, but it happened a
Oh,
lot.
wow. This is something that I've been seeing with my friends recently, actually. Some of them going through divorces and trying to figure out, one wants to keep the house but can't afford to buy out the other. And then they ultimately have to just sell the home and go their separate ways. Is that something that you see happen often?
Yeah, usually one of the two would like to keep the house, especially when you have
Yeah,
kids involved. They want to stay in the
for sure.
same area. Uh, but if they can qualify, or we can have a co-signer, or it could be that the solution is to sell the property. But as a mortgage broker, we always, we're not there to tell them uh, the parameter of their deal.
Of
But
course.
again, if one of the other came out to us and say, "Guys, I have to give her $150,000 to buy back her share," that's something that Martin and I help to do. Yeah.
So, really, when it's worth doing, to summarize, is when a new interest rate is low enough to offset the penalty costs. When you're paying off high interest debt, it's funny, we often get into these debates about, my friend got a 429 instead of a 434, 5 basis points, and they'll haggle over the interest rate on their mortgage. But in the same breath, they're paying 22 to 29% on their credit card, and for some reason, they never argue about that. Um, and when it's not worth doing is when the penalty is too high. And even by getting a lower mortgage rate, one and the other is just not worth it. Um, and also, as I mentioned before, I mean, it won't solve if you're a spender and you continue to spend after you've refinanced. You're going to find yourself quickly back into the same situation, except you'll have spent the equity that you used to refinance and pay off your debts the first time. You just won't have access to that equity again, and then you're really
Yep.
going to find yourself in a jam. So what you need to do is address the root cause of the situation you put yourself in, and often it's behavior, and behavior is spending too much money.
Yeah, and you got to make those changes, right? I did this once before, guys. A few years ago, refinanced our home to pay down some bad debts. I cut those credit cards up. That's
Well,
important.
that's
Get
just
rid of
it.
them.
Yeah.
You got to get rid of them. By the way, LJ's not here today, as you may have noticed, but that doesn't mean that he is not available to answer your questions and help you with anything that you may need. If you own a multiplex and you're looking for somebody to help take the hassle out of property management, check out the Plex Doctor. You can call them at 514-709-6397 or visit their website at Plex Doctor. That's PLEXDR.com. And all of the information can be found there. You're listening to Under One Roof MTL on CJD 800. I'm Robin Flynn with Fred Pichette and Martin Spalding of Fred and Martin Mortgages. We are discussing long-term rentals versus Airbnb right now. I think a lot of people, when they purchase an investment property, are trying to decide what is the better option, long or short-term rentals. How can I maximize my investment? So let's dive into this one together. Martin, maybe you can start us off by looking at things like profitability.
Okay, so I have friends that have both long-term rental properties. So long-term meaning, they'll rent their duplex for on an annual basis, and if everything goes well, the only time you see their tenant is at time of lease renewal. So it's all a return on investment, right? So if you want steady passive income, which is hopefully hassle free, long term is something to look at. When you look at short term rentals, I've got a couple friends that are actually got some short term rentals in the Tremblant area. So, Tremblant being tourists, a lot of people are foregoing going to major hotels because it's sometimes cheaper and it's sometimes easier to pile your family into a short term rental, an Airbnb, but it becomes the equivalent of running a hotel. You're renting rooms or you're renting a chalet, and so you got people checking in, you got people checking out. So when they check in, you got to make sure that it's ready. So the linens, the towels, the place has been cleaned, the garbage has been taken out. When they check out, you got to send the crew in, or you have to go in and do the laundry, make sure the beds have been changed, and make sure it's in an orderly fashion so that you can get the new tenants in as quickly and as efficiently possible. So it's two philosophies. So if you want to generate more revenue on the same, say, call it rental property, you should look at short term. You should look at Airbnb. But if you want to have more of a headache-free operation, then you should look at long-term and where you're renting on a semi-annual or an annual basis.
Martin, are you really making more money running a Airbnb than having a long-term tenant?
Uh,
Especially in Montreal now with the new law that you could do Airbnb only from June 10 to September 10.
Well, it depends, right? So there's been a lot of climbing down on people who are just running Airbnbs anywhere in the city, and the city has really stepped up, mainly in Montreal and Quebec City, where they're permitting people to run Airbnbs in what we call residential areas. So if you own a house in NDG, I'm not saying that you can't run an Airbnb, but the cities kind of frown on those types of operations. So if you're in more of a tourist area and you've got a condo or you've got a duplex or you've got an extra room in your house, then you set up an Airbnb, and the experts say that you could probably generate 2 to 3 times more than if you were running a long-term rental. However, if you've got people coming in and out, it's a lot more work than just renting an apartment to somebody on an annual basis. As I mentioned before, if you rent it on an annual basis, you'll meet the client, they'll sign their lease, and 6 months before it's time for them to either move out or stay in, then you'll send them their lease renewal. And if they sign, off we go. So the passive income comes in, and it's pretty much labor free.
Oh,
Yeah, I imagine the expenses for Airbnb would be a lot greater based on what you outlined, Martin. You've got to get a cleaning crew in between each and every tenant that you have,
Well, it's
right?
also, your furniture's in there. So it's wear and tear on absolutely everything. So wear and tear on your couch, wear and tear on anything that you're allowing your tenants to use. It's very similar to a hotel room, but it's under the guise of an Airbnb.
and also one more thing, it's very hard to finance those properties because the risk is bank find out that the risk is pretty high
Yeah,
on a Airbnb.
most of the time lenders don't allow you to use the rental income of an Airbnb to qualify your file. Whereas when you're buying a duplex and you decide to live in one of the two units, the other one, the rent that's being generated by the other one can actually be used to qualify the
As
file.
an income. Yeah.
Exactly.
Oh, wow. And I imagine it's harder to get home insurance when you are using that property as an Airbnb. The civil liability insurance has to be quite high.
That's a great question. I don't have the answer to that, but I will definitely get you that answer. But I can only imagine if you're running an Airbnb, there has to be a liability insurance. Because God forbid something happens to your tenant, the tenant will turn around and you'll be to blame.
I think the liability insurance it's up to $2 million.
2 million.
Yeah, it
Yeah,
could
that's
very
what
well
I'm
be.
I
seeing
think
as
it's
well.
pretty high. Like it technically will cost you much more.
Well,
than your
it's
insurance.
And you
actually,
need to-
I'll make a direct parallel. So Fred and I, we've got an office in WeWork. on L'Avenue des Canadiens. And because we have a closed office, not in the common areas, but because we have a closed office, we need liability insurance. So if you transpose the needs of WeWork onto a rental property that's being operated as a short-term rental, I can only imagine you'll need liability insurance. So if anyone's out there who's got the answer to the question, just call in and let us know.
You also are required to have a permit as well if you're operating an Airbnb. You used to, not that you used to not need a permit, but when all of this was new and we didn't know how to regulate it yet, I mean, I remember friends who were renting apartments and then renting out those rentals on Airbnb, which is very much no longer allowed, right?
No, you're running a business. So, I mean, Airbnb will actually kick you off if you're not abiding by the regulations because they don't want to get jammed up by the cities that they're operating in. So you got to run it like a business. So GST, QST, it's declared income, it's business income. So you got to pay tax on it if you're making over $30,000 a year. So it really is running a mini hotel. There are a lot of pros and cons to it. I mean, especially if you got a spare room in your house and it's not generating any income, it can offset your costs. But you're running a business.
Yeah, but I have to say also, some people are pretty successful at it. One of her clients, she live in Villeray near Plateau, and she has a bachelor, and she's renting out a lot during summer. She told me that, Fred, I'm getting excellent income. It's almost rented every single week, which is I don't want to scare anybody, but it's doable. You know, if you live in the property and you're there and you have time and you're committed to manage this little business, it could be worth it, absolutely. But again, just keep in mind that it could be very hard for financing afterwards.
Yeah, absolutely. If you're not sure what to do, you're about to buy an investment property and you're not sure, should I rent it out long term, short term, Airbnb, find a normal annual basis tenant, give LJ a call, LJ Aguinaga of LJ Realties. He can help you figure out what's the best move here. 514 500 4040. He is happy to receive calls and texts from you, even while he's on vacation. You can give him a call and a text if you so choose. You're listening to Under One Roof MTL on CJD 800. I'm Robin, that's Fred, that's Martin. We are with you for another 10 minutes, and we're with you every Sunday, by the way. We love hanging out with you from noon to 1 each and every Sunday right here on CJD 800. Guys, we do not have a winner yet for our trivia question of the week, so I'm going to ask the question one more time before we do our property of the week to give folks another chance. So the trivia question this week: what percentage of the value of a property should you set aside for closing costs? If you think you know it, 514-790-0800. The first person to text in the correct response wins cookies from Felix and Norton delivered straight to your door. So there's something in it for you. You want to get this one right. So I'll give you a sec. 514-790-0800. But let's tackle our property of the week. This is usually handled by LJ, but LJ is enjoying some much needed and well-deserved time off this week. Gents, who do we want to handle property of the week? Do you want me to take this one?
We're also staring at the script because LJ sent us his.
You've got it. I wasn't sure if you had it.
No.
Okay.
We all have it. So why don't you do a couple of the sentences and then we'll jump in we'll share it.
It takes 3 people to fill LJ's shoes.
Absolutely, absolutely. He's a one-man wrecking crew.
Exactly. So this week, our property of the week is live in the heart of downtown Montreal. Welcome to 1200 Rue Crescent, apartment 408. It's a modern 1-bedroom, 1-bathroom condo designed for stylish city living, and it's listed at $450,000.
I think Fred's going to go for it now.
Well, enjoy an open concept layout, sleek kitchen, and floor-to-ceiling windows that flood the space with natural light. Step outside to your expensive private wraparound balcony, perfect for unwinding with stunning city view. Plus, a rare indoor parking adds unbeatable convenience.
Located just steps from restaurants, cafes, shopping, and public transit, this is an urban living at its finest. Perfect for professionals, investors, and first-time homebuyers.
Now, of course, we asked LJ for his food recommendations in the downtown area. There's a million options around the Crescent Street area, but LJ recommends Bustan if you want to go for a classic shawarma. You can't go wrong. Mandy's for a hearty salad. I personally love the lumberjack salad. That would be my recommendation. Or Siam for great Thai. I've actually never been to Siam.
Oh, we've
Have
been to
either of you
Siam
been?
quite a bit, and actually, I think Fred
Oh,
knows the
okay.
chef at Siam because
Yeah, yeah,
a lot of people
Oh,
don't
wow.
know that Fred used to run the Thai Grill. So if there's anyone who knows Thai food in this city, it's
yeah,
Fred.
yeah, yeah. And the food is good at
Amazing.
Siam. I got to say, we went a few times and it's good.
But I went to
Oh,
check out the
excellent.
property because actually this is the property that LJ posted on Instagram, and it's got this beautiful wraparound balcony, which is really rare for a downtown property. And he's actually standing in the snow, and the snow by the end of the week will be gone. So you'll have this incredible deck on which you can barbecue. And the other thing that I noticed, it's right across the street from Hurley's. So, Robin, I think you know Hurley's. Back in the day, we used to do
Oh, yeah.
we used to have a lot of fun at Hurley's.
Yeah, I think our sister station, TSN 690, Mitch Melnick, just broadcasted from there on Friday, right? His annual
Well, there you
St.
go.
Patrick's Day show. It is friend of CJD and TSN 690. We love Hurley, so highly
It's
recommend.
fun. It's unpretentious. It's come as you are.
Yeah.
Great bands and a plethora of drinking options.
Oh, for sure. And you'll probably catch Shane Murphy down there. He's one of Montreal's greatest rock and roll acts. So always
It's a
great to
great
see him
spot. So, can you imagine
perform at
living right
Hurley's.
across the street from Hurley's?
Woo,
That could be a
wow.
good and bad thing.
It'd be a lot of fun, that's for sure. Guys, we got a winner finally to our trivia question of the week. Brought to you by Felix and Norton Cookies. The question this week: what percentage of the value of a property should you set aside for closing costs? The answer is roughly 1.5%. This will cover your welcome tax if you need to pay one, legal fees, title insurance, home inspection fees, whatever you need to take care of when you're purchasing a property. Our winner this week is Nikki. Nikki, I will be in touch to get all of your information so that we can deliver those cookies from Felix and Norton to you.
But
That
Robin,
pretty.
worth
Oh yeah.
saying, the 1.5% is what the lender obligates the borrower to
Yes.
show or the buyer to show. We always recommend not to be house poor. Make sure you've got a little bit of disposable income, especially for her first-time home buyers. All of a sudden you show up and you go, oh my God, I need to buy a shovel. I need to buy a lawnmower. I need to buy a picnic table. I need to buy new curtains. I need to And if you've stretched yourself just to purchase the property, sometimes you put yourself into a predicament where you're going to be house poor and you won't be able to do anything else but live in your house.
And make sure you don't finance all of these things that you're buying, your appliances, right before you go to notary. That is super, super important.
No,
You don't
actually,
want to
it's
be
not
putting
so
a
bad in
ding.
notary. It's before applying for a mortgage. So,
Okay.
don't load up your credit cards. Don't go and sign for a new car.
A new car, especially
Yeah,
a new car.
A lot of people will go, oh my God, had I known, I wouldn't have signed for my car until I went to the notary. Post notary, I would have signed for my new car because all these things show up on your credit report, and all these things are obligations, monthly obligations that can hurt your ability to qualify for your mortgage.
Very, very important. All right. What did we learn this week? We learned that the Bank of Canada cut interest rates again this week by 25 basis points, and we are expecting more cuts in 2025.
They're actually
this could be
saying from now until October, they're expecting 25 basis points per announcement.
Wow.
And there could even be a 50 basis points announcement. It depends on where the economy is going. And also, Mark Carney just became the prime minister on Friday. So are we going into a spring election, or are they going to wait for the fall? There's all that uncertainty out there that is affecting the Canadian economy. And the Bank of Canada is sort of sitting there going, what do we do? What do we do? What do we do? Because we don't want to lower it so much that we then create inflation where they're going to have to bring it back up. So it's where's the balance right now? But I think that they're going in the right direction, and it's good for people who are carrying debt. However, you don't want to push it too far to bring inflation back.
And Martin, when is
For
the
sure.
next announcement from the Bank of Canada?
It's in March.
April.
Oh, so we're already in March.
We're already in
Sorry.
March. It's
Oh my
April
God, where's the
16th.
time fly? I'm sitting here going, my God, are we
Yeah.
already in March?
Yeah,
April.
it's
Sorry.
April 16th, the next one,
My
and
bad.
there's two other ones, one in June and one in July.
Yeah.
Which is rate cuts are there for sure.
Oh, wow. We also learned that it could be a good option for you to refinance to pay off bad debt. You can refinance your mortgage to do that, but speak to an expert like Fred or Martin to find out if that's the right choice for you right now. You got to pay close attention to what those penalties are. Look at those conditions on your mortgage. Get to know your maturity date. These are all important factors to consider. Also, Airbnb versus long term rental. It depends on how much effort you're willing to put into your passive income. If you are okay with getting in there and cleaning that unit every single time you have a tenant check in and check out, go for it. But long term rental might be a bit easier and less maintenance. That pretty much does it for us for this week. We will be back next Sunday at 12 p.m. right here on CJD 800. In the meantime, if you want to learn more about the guys and the show, you can visit our website, underoneroofmtl.com. You can also get in touch with LJ, Fred, and Martin individually. Fred, Martin, where do people go to get in touch with you guys?
Very simple. fredmartin.com. All our information is on the website. You can even book us through our calendar for a consultation. No cost to you.
Amazing. If you want to get in touch with LJ Aguinaga of LJ Realties, visit his website, ljrealties.com. You can follow him on all social media, LJ Aguinaga or LJ Realties. You can also call or text him at 514 500 4040. If you missed anything, you can listen to this show in its entirety and previous shows on the iHeartRadio app, Spotify, Apple, or wherever you get your podcasts. For LJ, Fred, and Martin, I'm Robin. Have a great Sunday.